Motilal Oswal Studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live this Tuesday morning from the CNBC-TV18 Motilal Oswal Studios. I'm Prashant, with me, my colleague Sonia and Nigel. Guys, hi, morning.
Morning.
Hi, good morning. A brand new day and indications are perhaps the start will be mildly in the green, but so many cues, right? I mean, today is a big day of earnings. Tata Motors, Bajaj Auto, lots coming out. And of course, you have the US Fed meet as well.
Yeah, the meeting kicks off and we get the decision tomorrow. So lots to track. So let's quickly kind of run you through what you need to know in terms of the setup as we always do. So yesterday, I mean, this is just kind of what you pick up from price action. The market looked like it was kind of sort of seemingly a little tired. I mean, you know, the price action kind of indicated that. And then that prompted me to look at where, say, just the Nifty 50 stocks are in terms of either being above or below their respective 20-day moving averages. Now, the 20-day is important. The 20-day simple moving average is an important short-term pivot between being bullish or being bearish. And this is the data. I mean, the numbers are still in favor of, for the market to go up rather than down. But at the margin, there is a little bit of deterioration which has happened. 68% of the Nifty 50 stocks are above the 20-day moving average. I mean, that's closer to 70%, so nothing to scoff at. But that number was 93% just earlier this month on the 5th of July. So, you know, you got to have a confluence of signals like this to kind of come to any substantive conclusion. We don't have that yet, but maybe we will kind of start to watch some of this stuff. Beneath the surface, what are the signals that one is getting? So keep an eye out on this one, and we'll kind of come back to this regularly. Now, overnight, you got the S&P, which was up another 0.4%. But again, I mean, a little tired, right, in terms of price action. The Dow was up 200 points once again. For the Dow, it is the 11th straight day of gains. It's quite something. The dollar index, though, that has moved up to about 101.4. From closer to 99, it's now up back up to about 101.4. The fall was swift from the 104 levels to 99, and we've come up from 99 to 101.4. So halfway into that, kind of halfway in terms of retracement back to those levels. Let's see. So that's the dollar. Later, out of the US, we get big earnings. Microsoft and Google will report earnings today. Because the rally in the US has been so large cap led, the numbers will be important. The Fed meeting starts today. The decision is tomorrow. A 25 basis point hike perhaps is likely. But, you know, the question, as I said yesterday, is whether they will give a clear indication that this is the last of the hike. There was a Wall Street Journal article from a reporter who's kind of known as the Fed whisperer. I mean, you know, his articles are keenly watched for what the Fed may do. And basically, he asked the question, why Fed? I mean, actually, the statement, why the Fed isn't ready to declare victory on inflation, which kind of gives you some indication of which way the wind perhaps may blow when we hear from the Fed chair. So, you know, it's not going to be exactly very dovish or anything. That's what the article suggested. We'll see if this one is right or wrong. Let's narrow all of this down to levels, really. For the Nifty, the support comes in at the same level that we put out yesterday, around the 19,600 level. The precise number is 19,620. The bigger one is the 20-day moving average for the Nifty, which stands at 19,423. And that is the important test. That's the important downside level. We are still quite a distance away from that number. For the Bank Nifty, the support comes in at 45,735. That is just 200 points away from where we left off yesterday. And then the 45,673 level. So you go to a very near-term hourly kind of exponential moving average, and then you look at retracements. So the big one for the Bank Nifty, at least from a pivotal point of view, is the 61.8% retracement of the recent up move from the low to the high, which is 45,244. That's about 650 odd points away from where the Nifty Bank left off yesterday. So about 1.5%, not that far away. So these are some levels to work with. The GIFT Nifty, I think, is not indicating very much by way of a clear directional kind of start. So take it easy. I mean, I think over the next 2 days, you got big data points out of here. Earnings, by the way, at the margin have not been all that great in the first quarter so far, I would say. Although a numerical assessment is yet to be made. And then out of the US, you get big earnings, and then the Fed decision tomorrow. The decision and the commentary perhaps in the near term will be important. Sonia.
I think that will be the next big trigger for the market, right? And in that, amidst all of that, the market has been a bit directionless. In fact, it's been the second day running that the Nifty closed with losses yesterday. So this morning, even if we do open slightly in the green, the market may be tentative through the course of the day because of many factors. First of all, there are 5 Nifty companies reporting their numbers today. So the market will, of course, wait for all of those cues to come through. The other thing is that there are a couple of internals that are not great for the index, whether it's Brent crude, and that's moved to almost $83 a barrel. So keep an eye out on that as well. The dollar index too. But then there are some positives that the street could latch on to. One, of course, is the fact that global markets have done very well. So the Dow was up almost 200 points yesterday, and it's been an 11th straight day of a rally for the Dow. So we at least have that kind of support for the market. Not just the US Fed decision that the street is awaiting, the Fed funds futures data shows a 98% probability of a 25 basis points rate hike. That's according to the CME Fed Watch tool. So it's a given perhaps that there's a rate hike coming. But all eyes will be on results as well. There's Alphabet and Microsoft that report their numbers post-market hours today. And the other crucial data point to watch is the July consumer confidence data. And that is the Fed's favorite inflation gauge. So we keep tracking that one closely for you as well. In the meantime, the Nifty, amidst all of this, has been a bit resilient. So it's held on to that 19,670, 19,700 mark. There was good buying from domestic institutions as well, over 930 crores, while FI sold a tad bit, not too much. So the flows are not too bad, actually. There was an earnings beat that came in from Tata Steel, more on that later, but that could aid metal stocks, perhaps, the earnings beat in the India business. And in that context, today you have Tata Motors that comes out post-market hours, Bajaj Auto at 1 p.m. And tomorrow you have a lot of earnings as Axis Bank, Cipla, Dr. Reddy's, Tech Mahindra, Bajaj Finance. So the market could perhaps position itself ahead of those big earnings tomorrow. But all in all, you'd have to say that there are some headwinds for the market that could keep the market a bit tentative.
Well, that's right, Sonia. You know, the overnight cues, though the Dow ended well in the green, you had a stronger dollar, as well as Brent crude prices moving up to around $83 per barrel. So those two both are headwinds from an India equities perspective. And we've really been spoiled, with the kind of run that we've seen, because this is the first time in nearly a month that we had 2 sessions where we ended in the red. That's the kind of run that we have seen. The second half of today, though, belongs to the Financial Nifty Services Index because that plays out the weekly expiry. The question I'm asking is, the Nifty has been showing some sign of, signs that it maybe want to pull back a little bit. Will it visit the 20-day MA before resuming its up move? And the Nifty Bank as well. So both those two indices are 1.5% to around 2% away from the 20-day MA, which becomes a crucial support. So, we'll know about that in the coming weeks. The FIs, well, they lighten positions both on the long as well as on the short side, but they continue to write calls. And yesterday as well, they wrote more than 2 lakh calls. That's in the ratio of 2 calls for every 1 put written. And 2 strikes are very active. 19,700 call, 19,750 call. Between them, they added close to around 85 lakh shares. So that's telling you the kind of call writing that we have seen. And the PCR has cooled off now. PCR has come down to around 0.8 odd. Remember, last week it was at around 1.6. That was when the bulls were taking it for granted that we're going to be moving up, and some complacency really creeped in. So from around that 1.5, 1.6, we have cooled down to around 0.8. But normally we see the Nifty bottoms out, or we see some kind of a bounce when it goes to around 0.6 to around 0.7 times odd. So we're a little bit distance away from those levels. Since it's the Nifty Financial Services Index expiry, 2 strikes to highlight. We got a broad range just looking at that, 20,400 put and 20,000 call. Moving to the levels then, the near-term support for the Nifty comes in at around 19,600 going by the options data. And if we break that, then we move down to around the 20-day MA. So that becomes the crucial band. I think we're in for a bit of a consolidation. That green on the screen, I don't know how long it will last given the kind of big event we have. But a 40-point gap up, I think you get only a breakaway on the upside once you get past the 19,850 odd mark.
Okay, well, lots to watch out for, and so many things have changed, right, in the last 24 hours. Twitter has now become X. And it's, I don't know if that's changed anybody's life.
The birdie flew away.
Finally, the bird is out of the cage, right? Okay.
Someone said that Google changed its name to Alphabet, but we all still call it Google, right? I mean, who calls it, like, Alphabet numbers are today, but I said Google numbers are today. But I don't know, will it really change? Will you
Even
tweet?
Facebook changed it to Meta, so I guess, the parent company, of course. Yeah.
Will you still exit? Will you exit or will you tweet it? I think tweet it, right?
I don't know what happens to the brand, though, I mean, that's it. Is this a class on how to... 101 masterclass on how to destroy a brand slow and steady? But okay, let's see how X is received. Maybe it's the new age Twitter. Well, goodbye to the birdie, but hello to the market. So let's take you through what you can see in the next 2.5 hours. On the equities front, you have Amit Sachdeva of HSBC, who says that FIs have bought $19 billion worth of Indian equities since March, aiding the markets to reach new highs, outperforming the region. Their observations from short and long run cycles indicate that FI flows can still sustain and bullish construct can persist in 2023. Risk of a sharp market decline is limited even with moderate FI outflows, as DII should cushion the market against volatility. HSBC highlights 3 implications for India. First, bullish construct of the market is likely to persist. Second, financial sector is well placed to continue to attract incremental flows. And third is the IT sector is into its 3rd year of continued outflow, and FIs being large underweight on this sector makes it primed for flows reversal once the global demand improves.
Okay, well, we got some rupee views as well. So Abhishek Goenka of IFA Global says that after a phenomenal risk rally seen of late, we saw investors turn a bit cautious last week ahead of key central bank rate decisions, corporate earnings, and amid a flare-up in Russia-Ukraine tensions. He says the Fed decision this week will be crucial from the perspective of the overall direction for the dollar and risk assets. He adds a 25 basis point hike by the Fed is fully priced in. He continues to expect the dollar INR pair to trade in a range of between 81.6 to 82.9 to a dollar over the medium term.
And on the bonds, Ajay Magnolia of GM Financial says, tracking the fall in US yields, the 10-year benchmark bond yield has been mirroring the trend and has been falling a bit ahead of the crucial Fed meet this week. He says demand in the SDL auction today is expected to be better and will sail through smoothly. He says stability in oil prices has been trying to play an anchor. A pause or hike by the Fed may turn the direction on either side, and he expects the 10-year benchmark bond yield to trade in a range of 7.05 to 7.1% today.
Well, there's a lot of stock-specific action that we're tracking for you, and we get to that in just a bit in our special Top 10 segment. But we're looking at a lot of earnings reactions. Tata Steel, JK Paper, Power Grid, SJVN, as well as AstraZeneca. All of them will be reacting to positive news flow. While it's even Stevens, 5 stocks will be reacting to negative news flow as well. Sharpest stop, Chennai Petroleum, DCM Shriram, Spandana Spurti, and IIFL Securities.
Okay, Adrian Movat is with us, Emerging Equity Markets strategist. Adrian, good to have you with us here. Thanks very much for your time. Are we going into a little bit of consolidation here, Adrian? Do you feel that way after the kind of rally that we've had? And what would cause it, in your opinion?
Yeah, I think in India we are going into a period of consolidation. And one of the reasons, I think, is the results season. So, India's had incredibly good economic data, strong growth, a PMI in the industrial sector that's positive, unlike most other countries. And that's led to perhaps a slightly higher expectation for results at the company level. And so with perhaps with the exception of the IT space, results are either in line or a little bit disappointing. And that probably sets us up for a consolidation. And I think we might have a sort of contrasting story, perhaps with the S&P, where results have generally been better than expected, particularly as we went into the year with this recession view, which has proved to be incorrect.
What about some of the earnings that came through from the banks? Did that not impress you, Adrian? Because it's been many quarters now of solid earnings from some of these private sector banks, like ICICI Bank, for example. Do you think that could provide some leadership to the market and take it to the next leg up?
Yeah, I'd probably rank it sort of IT and then banks in terms of the leadership for the next move in the markets. But we've had some big bellwether stocks. Perhaps the sort of Reliance numbers would be indicative of that, where perhaps expectations haven't been met. And remember that we're talking about expectations against a backdrop of an equity market that's done very well, particularly with respect to the other major emerging markets.
Mm-hmm. Hi, Adrian. Good morning. But do you get a sense that global equities and maybe India as well, the Indian equity markets have run ahead of themselves? And there is, there is good reason that we should see some bit of consolidation or maybe a bit of pullback?
Yeah, look, I think there are arguments for consolidation. So we had at a macroeconomic level a very positive print with the inflation number out of the United States, which helped a sort of a macro level rally. Plus, we've had good results and we've had this hype around AI. That inflation print resulted in the DXY touching 100. And I think the dollar weakness is probably overdone. So I would suggest, and this is sort of very near-term view, is that sort of July and August, or the balance of July and into August, is going to be marked by a strengthening of the dollar. And that might conversely mean that equities either tread water or come off a little bit.
Adrian, do you believe we will get a clear signal tomorrow that this is the last hike in this current tightening cycle from the Fed?
No, I don't think we'll get a clear signal tomorrow that this is the last move. I don't expect a significant change in the Fed's language. You know, the Fed has some good news in terms of inflation is trending lower, but it's still well above their target of 2%, you know, whether you look at headline or core CPI. Plus, the employment data still remains very robust. So I think it's really balanced whether the Fed will move rates up twice, so once tomorrow and then again at some point over the next couple of meetings. So I would be very surprised if Powell was to reduce his flexibility by making a clear call.
Okay, so finally then, Adrian, last question from my side. The Dow has been gaining for what, 11, 12 sessions now, and it's been a global rally that has taken India with it, right? What should an average investor do? Do you continue to invest into markets like India, or do you take a bit of a breather now? And what would your pecking order look like in the emerging markets for the rest of the year?
Yes, it's sort of interesting that you said the Dow rather than the S&P or NASDAQ. And so that there's a broadening of the market. And as you know, the equally weighted S&P index has been a big laggard versus the market cap weighting. And what we've seen in the US market, if there has been a sort of sectoral change, it has been the financials that have been moving the market and perhaps moving the Dow. And you can see the moves that we've had in the likes of Bank of America, JP Morgan, etc. And these have been all based upon good results. So you asked me a question about, what I thought about the Indian bank results. There could be a halo effect if the rally in the US is supported by financials that helps Indian financials.
Okay, all right, we leave it at that. Thanks a lot for stopping by and speaking to CNBC TV18. Appreciate your time here. That is the word coming in from Adrian Moat. Let's slip into a quick break. There are plenty of stocks to talk about and so many that you need to keep on your radar. So more on that coming up in a bit. Welcome back to Bazaar Morning Call. Hope you're having a good morning so far. The gift nifty is indicating that it could be a quiet start. We'll take it from there, but plenty of stocks to talk about. Of course, top of mind will be Tata Steel post its Q1 numbers. Nigel, how did it look this time?
Well, the numbers look better than expected, actually, and that was primarily because of the India business. So the consolidated EBITDA number, well, that beat our estimates by close to under 100 crores, and the margins, well, more or less in line because the top line was better. Now, the India EBITDA per ton, well, they reported it came in at around 16,000 rupees per ton. Our poll was at around 13,500 rupees. So it appeared like it was a big beat because on a sequential basis, it would mean there was no decline. I know the street was penciling in a 2,000 rupee, 3,000 rupee odd decline out there. But you need to note that in the reported one that they're giving, the EBITDA per ton, it includes other income. So stripped of that, the number will be closer to around 14,000 rupees per ton. So it's yet a beat, but by not that big a margin. We'll quiz the management how much of their other income is sustainable going ahead, or is it entirely a one-off? Europe continues to struggle though, because they've reported a loss of close to $95 per ton. That's on expected lines. They had a shutdown, demand was weak out there, and higher input cost would hurt them. The debt number as well has moved up a little bit by close to 3,500 crores because the capex spend was around 4,100 crores odd. So that's a little bit of a niggling worry, but we'll be joined by the management later today, and in fact, they'll give us further details. In fact, later on the show, we'll be joined by Amit Dixit of ICICI Securities at around 9:40 a.m. He'll tell us about what he makes of the numbers and what's he looking for from the con call.
All right. Thanks very much, Nigel, for that. So more on Tata Steel coming up a little later. Now, Shoppers Stop is the other one which we want to focus on. Reported earnings. Mangalam is here with details. Mangalam, morning.
Well, it was a rather soft quarter coming in for Shoppers Stop after a spate of good results coming in from there as well. Slight weakness in terms of sentiment, but at the same time, the company has been transforming a lot of their stores, so that impacted overall sales. Sales grew by just about 5%. No problems with the EBITDA. That grew in step with the sales growth, and as a result of which margins were maintained around that 17% mark. But the net profit saw a sharp hit, and that's largely because depreciation came in from around 85 odd crores to 105 crores. The company is on a bit of a capex spree. In fact, this quarter itself, there was a capex of close to around 43 odd crores, where they are renovating a few stores and opening a few more stores as well. But some of the internals that track well for them, there was a growth of 8% in their average transaction value, telling you that premiumization is well and truly on its way. Beauty products did well for them. 13% sales growth is what we saw out there, one of the fastest growing verticals. And own brands, private labels, contributed around 14% to their overall sales and 21% to the apparel business, which is, again, a high margin business. So as a result of which the internals are good. But because of the externals and the company going ahead and renovating a few stores, maybe the next couple of quarters would be rather soft. And that's what I expect in the stock price today as well.
Okay, thanks a lot, Mangalam, for that. Well, let's go across to Sonal now. She's tracking a couple of stocks. There's Chennai Petro, there's DCM, Shriram. Sonal, good morning.
Good morning, Sonia. Well, both of the stocks I expect to be in the red today. Chennai Petroleum, we've been talking about how Singapore GRMs have declined. Spreads and cracks are lower as well. And that is something that we are seeing in the numbers as well. Revenues declined 18% on a sequential basis. EBITDA is down 44%, leading to a margin compression of 300 basis points and a profit decline of 45%. GRMs too have come in at $8.3 per barrel versus $12.5 per barrel. Currently, GRMs have seen a tick up, but we'll have to see whether that sustains or not. For DCM Shriram, it was the chemicals business which led to the drag. Revenues were down 2%, EBITDA was down 60%, leading to a profit decline of 78%. As I said, the chemicals EBITDA was lower, and that was down 90% on a YY basis at 36 crore rupees. The vinyl business saw a loss of 3 crores versus an EBITDA of 70 crores. This is due to lower pricing and a lot of inventory issues as well. So that stock should be in the red as well.
Thanks a lot for that, Sonal. Well, let's hop across to Abhishek. He's here to tell us about Spandana Spurti. Morning, Abhishek.
Morning, Nigel. Another one to add onto the red side will be Spandana Spurti, as cost of funds have weighed on the performance. Disbursements are up 26% YOY, but they have declined 45.5% sequentially. How much of disbursements have gone into AUM? That ratio is now at about excuse me, 20% versus 54% that you saw in previous quarter. So AUM growth is at 60.5% YOY and about 4% sequentially. Asset quality has improved. However, NI has declined by 11.5% quarter on quarter. Operating profits, they have declined by more than 29% quarter on quarter. And due to the fact that provisions have come down by 74%, the PAT decline is just about 4% on a sequential basis. So expect the stock to be in red today.
All right. Thank you very much, Abhishek, for that. Well, more numbers. JK Paper, IIFL Securities, Surabhi's here with details there. Surabhi, morning.
Morning. So for JK Paper, it was a good set. The revenues were up 11% on a year-on-year basis. There was some pressure on the gross margins because of high paper pulp costs, but they've still managed to maintain the EBITDA margins at 30%. The profit was down 18% on a year-on-year basis, but this is due to higher finance cost, and this is due to higher capex that they have done last year. Finance cost is expected to come down later during the year. For IIFL Securities, it was a weak quarter. Though the revenues were up nearly 2% on a sequential basis, the total expenses were up 8%, which has dragged down the profitability by 13% on a sequential basis, came in at 75 crores versus 86 crores. Also, the customer acquisitions was down 12%. This is the lowest it has been in the 12 quarters, so expect the stock to be in red today.
Okay, thanks for that. Well, let's go across to Vivek. Now he's tracking Power Grid, SJVN and AstraZeneca. Vivek, over to you.
Well, good morning. Quite a few stocks on the radar, like you mentioned. So, Power Grid, interesting development coming in there. The company's subsidiary, Power Grid Bikaner, has gone ahead and commissioned Rajasthan Solar Energy Project Transmission System. Over 8 gigawatts of project has been commissioned, and this particular commissioning has been done on a build, own, operate and maintain basis. The other stock to keep on your radar, SJVN, this particular stock has been on a tear lately. Some more positive news flow coming in over here. The Arunachal Pradesh government now has gone ahead and allotted 5 projects over 5 gigawatts for this particular company. All of the 5 projects are based and located in the Dibang Basin, and this particular project that the company has got, the company says will require an investment overlay of over 50,000 crore. Important to see the timelines as well as what exactly the company will get once these projects are commissioned. The stated targets as far as the company is concerned in terms of commissioning, 5,000 megawatts by the end of FY24, 25,000 megawatts by 2030, and almost 50,000 megawatts by 2040, and 50% of this is expected to come from incremental renewable energy addition. Lastly, AstraZeneca, some positive news flow coming in for the company as well. Company has received permission to import pharmaceutical formulations of new drugs for sale. The permission has come in from the DCGI, and this drug is used for the heart failure drug. This particular commissioning that the company has got paves the way for launch as far as the Indian markets are concerned. So I expect AstraZeneca to be in the green today.
Okay, all right. Thanks a lot for that, Vivek. Well, here's a quick recap of all the stocks we just covered. Stocks with positive news flow include Tata Steel, JK Paper, Power Grid, SJVN, AstraZeneca Pharma. Well, stocks on the flip side, that's with negative news flow, include Shoppers Stop, Chennai Petroleum, DCM Shriram, Spandana Spurti, and IIFL Securities. Well, those are about all the stocks that are in news. Well, let's hop across to Manisha Gupta, who joins us this morning to give us a wrap of all the commodity action. Morning, Manisha.
Morning, Nigel. Thank you for that. I'll start with the crude oil prices, where we are trading at a 3-month high. We've seen prices gain up by 2% overnight, and we're leaving behind 4 weeks of gains rather, and we're holding above $83 a barrel right now on your screens. So tight global supplies, firm China demand and supply expected to tighten following the OPEC and allies. It has been supportive. The markets also will watch out for the U.S. Fed 2-day meeting that starts today. And while the 25 basis point of a rate hike has been factored in, it is going to be about the future guidance that the markets will really be hinging on. So while the crude prices are trading firm, that's not the case with the metals. With the dollar index back above 101, we have seen pressure come in for the precious metal prices, and the base metal prices also have eased further. The Chinese demand concerns, especially for metals, has been weighing on. So copper is moving away from its 3-month highs. We're also looking at steel and zinc closing, or rather, they did close the night on the negative there. And the Asian markets haven't really made any more progress on that.
Thanks very much, Manisha, for that. We'll take a quick commercial break here. But up next, Prakash Devan will join in for a quick fundamental stock check. A little later after that, we'll have the management of Jammu and Kashmir Bank to talk about their first quarter earnings. Stay tuned.
Welcome back. Hope you're having a good morning. Well, after a few days, we are seeing that the implied opening for the Nifty will be in the green. Close to around 40 points is what the implied opening is indicating. But we know last few sessions, we've ended virtually at the low point of the day. But plenty of stocks to discuss. So let's get in Prakash Diwan, who joins us. Hi, Prakash. Good morning. Well, let's talk about the big result that came in overnight. Tata Steel. You know, the India business looked quite good, but it had a component of other income as well. So stripped of that, it was a beat. But how do you approach the stock from here? Because Europe continues to struggle.
Good morning, Nigel. So, while I do love this business and we've spoken about it as one of the transformative, opportunities that's available in a sector that's cyclically not the greatest, Tata Steel exactly endorses that. Right? Everything about the numbers tell you that there is a bottoming out that's evident. In fact, 16,000 per ton is not something which is very great, to be honest. I mean, but the expectations were very low, so it seems kind of optically that they've managed to scrape through. But the European business is something which is what I'm banking on in terms of a revival. And fortunately, what's happened is in the last many months, China has not been able to kind of ramp up or has chosen not to ramp up and flood the market with a lot of supply, especially in the European markets. And the European players themselves, localized supply points have actually drained out. So Tata Steel stands at a very good opportunity, but they've had to have this pain to tolerate this pain to reach there. The only worrisome part is that debt. It's a bit niggling that while you were deleveraging all this while you got the debt, but then that's because of the kind of acquisitions that they're making and the consolidation that's happening. But I'm very positive if the market gives you that opportunity to buy at lower levels, it could probably be in the red as well, given these numbers. You would actually buy for the long term. My target is about 30-35% higher from here in the next 12-18 months.
Okay. Prakash, hi, good morning. I wanted your thoughts on how one should approach TVS Motor now, because the numbers were good, no problems about that. But there are some niggling worries, right? I mean, the company is investing in its loss-making subsidiaries. So the debt for the company has gone up a tad bit and valuations are not cheap anymore. What do you do with the stock now?
Good morning, Sonia. You're absolutely right. Everything is good. What's happening, the transformation is evident, but the valuations are definitely expensive. And what happens is there's a lot riding on the revival in the domestic rural economy and the demand and the export segment. Now, if any of these let you down or both of these let you down, then these valuations will start seeming very stretched, because then you will have to have a significant time correction to catch up with the levels that the stock is at. And people probably choose to switch to something else which might be slightly more racier. So I think it's good to kind of stay away right now from adding up. We've discussed about this at sub 1,000 levels, which has been fair enough in terms of where you're getting into a good risk reward equation. But at 1,300 plus, it is a bit pricey. So I would kind of look at other things at this point and not add to it.
Got that. Prakash, just a quick word on two names, and I'll highlight these on charts as well a little later. One is SRF, where the stock's been a rank underperformer, and the other one which sold off right at the end was Sharda Cropchem. Your thoughts on these two?
Good morning, Prashant. So I think very clearly there is an evident hit that all of these large chemical plays have had to take because of the kind of recessionary tailwinds that they've been facing on so many pockets of demand. It's unfortunate that some of these companies have had expansion within this space of agrochemicals, and that's what has let them down. So, for example, SRF. I mean, they've gone into a lot of specialty chemicals, a lot of other businesses, but this has let them down. Sharda Cropchem is all of it into this. But I'm quite intrigued by the fact that the market is not yet penciling in the fact that the inflationary numbers that you see, the kind of data that you're getting from the agri side globally, I don't see any reason why food grain prices or any agri commodity prices would actually give you any sort of a softness from here on. If prices remain this firm, usually correlation is agrochemicals will do very well. So my sense is this is an opportunity to buy into some good names. SRF, probably the guidance tells you not to do it immediately, but I would look at a PI, I would definitely look at a UPL. So there are these headwinds which are positive for this sector, Prashant, and probably you would look at it after a quarter or two. But at this point in time, there's too much pessimism which is riding on the prices in SRF particularly.
All right. Prakash, I was looking at a note coming from DAM Capital on Sharda Cropchem. They have cut their earnings estimates by 75% for this year. That's FY24, and FY25 it's down by more than 20%. So that's telling you how weak those numbers were. Stock was under pressure, and big earnings cuts is what we have seen.
Oh, God. Okay. And that's something that, of course, the street has also perhaps priced in. Just look at that. Maybe not priced in completely, but at least the street is aware of the kind of earnings pressure we've seen. Well, let's move on. Prakash, just invite you to stay on for a tad bit. We have J&K Bank that's joining us. So I'm going to ask you to listen in and perhaps give us your comment. The bank reported a good set of earnings for Q1. It was a strong operating profit growth aided by the other income. Their net interest margin has expanded. The asset quality has also improved. Baldev Prakash, the Managing Director and Chief Executive Officer at Jammu and Kashmir Bank, joins us now. Mr. Prakash, thanks a lot for joining in. Appreciate your time here on CNBC-TV18. Your advances went up almost 18% this time around. Your asset quality has also improved. So let's start by talking about the loan growth. What kind of loan growth are you penciling in for the full year FY24?
Yes, good morning, Sonia. Yeah, so our guidance was around 15% of loan growth, and we are right on the guidance, and I'm sure that this momentum will be maintained. And the major advances growth is coming from retail segment, particularly the housing loan segment, and from the both territories, our core territory of Jammu and Kashmir and Ladakh, as well as the rest of the country branches also. So the major driver of the loan growth is our retail segment so far.
All right. Hi, good morning, sir. What about the NIMs? They're looking quite impressive, currently almost at around 4%. So where do you expect it to settle? Because there's a scramble for deposits, and you're indicating that you're going to grow as well by mid-teens. So give us a number on NIMs as well as your cost-to-income ratio. It's been coming down, but I believe you were looking at mid-50s. Currently, it's in the lower 60s. How does that move?
Yes. Good morning, Nigel. So as far as NIMs are concerned, we given a guidance of 3.7 to around 3.90. This quarter has been extremely good. We are touching almost 4%. And given, I think, the growth which we are seeing, particularly in the retail segment, where the margins are a little higher. So we are hopeful to maintain this around this range, around 3.9 or something like that, and maximum 4, which what we are looking for. And as far as the growth in advances is concerned, I think we will be able to maintain the momentum. And particularly this quarter onwards, we are expecting some uptick in the advances in corporate side, the book of the bank, particularly in the rest of the country.
You were making a point on cost
and cost to income. Yeah. Yes. So cost to income ratio, Nigel, if you see, there is a trend. We have come down from a very high level of 76. And we are maintaining this momentum, but of course, some rigidities are there in the system, particularly from the staff benefit side. We are addressing that slowly, but I'm sure we will be reaching to the level which we have advised to all our stakeholders.
All right. Mr. Prakash, hi, good morning. So 2 questions. One, you said you told us that retail and agri is about 80-85% of your overall book. And you said housing now is doing is the one which is the segment leading the loan growth. How much is housing now as a percentage of the retail book?
Yeah, so housing is around 20% as of now. And the way we are seeing this growth, we will be reaching it around 25% very shortly. And the other segment which is growing as good as the housing is our retail loans to our the personal loans to our staff, our government employees, government staff from Ladakh as well as from the Jammu and Kashmir government. So that segment is also seeing a lot of improvement, particularly on the strength of our digital initiatives. We have provided a STP facility to them. So within a time of just 10 to 15 seconds, they are able to get the loan. So that is also seeing a very good uptake.
Mr. Prakash, 25, so home loan share will go from 20 to 25% this year, by the end of this year?
Yeah.
And you told us that
what our target is.
You told us that government employee share is was 20%. Where is that now, and where do you see that rising? What do you see that rising to?
So far, it is in the range of 20 to 21%, but we are seeing it again going to around 25 because ultimately there is a limit to that. We have around 40% of the staff which are still not covered under those loans. So we are targeting that during this year. So maybe around 25% we are seeing a growth in that loan also.
Okay. Can you tell us a little bit more about asset quality? Your gross NPAs have improved this time, so asset quality has improved quite a bit. But do you see the, gross NPAs pick up further? I mean, do you see it lower than that 5.7 level? And if you can also tell us what is the outstanding restructured book at the moment?
Sonia, this assets quality has been the biggest strength of the bank in the recent past. And we have come down from 6.4% to 5.77 on a Q&Q basis. And as far as the future strategy is concerned, I'm sure the type of steps we have taken now, we will be ending this year around 4.5%. And as far as restructure book is concerned, we had around 5,000 crores of restructure book. As of now, we are having around 2,200 crores. 250 crores have been recovered during this quarter out of this restructure book. So this book is holding. There's hardly any slippages out of this.
So just so you said 4.5% gross NPAs by the end of FY24, correct?
This year.
And can you just, by this year, okay, can you break it up for us? Where are you seeing the improvement? Because you said large part of your book comes from retail and agri. So which are the pockets where you're seeing an improvement in asset quality as well?
All across, actually, but the major is coming from corporate book, which is particularly from rest of India and some part of the Jammu and Kashmir also. And those big loans, which are quite old, actually, almost they are fully provided for. So that recovery is now coming with the support of a lot of efforts from the teams down the line.
All right.
And moreover, Sonia. Just a moment. If you hardly any slippages are there in the book now.
Okay, very quickly, you're doing around 300 crores per quarter as a profit number. So you'll end the year at around 1,200 to 1,400 crores. Is that doable? But you have a target of 4,000 crores of PAT. By when do you get there?
Yes. So we have given a target for 5 years for financial year 28. That was the guidance given. And this year, definitely the number which you have given, we should be achieving that number. And in the long term, in the 5 years time, we will by FY28, we will be reaching to the 4,000 crore level also.
Good speaking to you, sir. Thanks so much for stopping by and giving us all those details. So this year, 1,200 to 1,400 crores of PAT. By the end of 2028, it'll be around 4,000 crores. For the time being, we slip into a short break. Up next, Anuj Singhal joins us to give us a quick trade setup. Post that, we'll bring you the top stocks for the day. Our technical experts as well as FNO experts will be joining us as well to give us some trading picks.
Okay, there's 11 minutes to go for the pre-open session. Anuj is here with how he's looking at things. Anuj, morning.
Morning, Prashant. You know, the issue for the market is that the broader market is fine. The Nifty is struggling for leadership. If you look at the big stocks, and for last 2 days now, we are ending at the low point of the day. And things were fine yesterday till 2:30. In fact, I jokingly made a point yesterday that why don't we close the market here? Because the last hour has been quite bad for last couple of days. ITC, of course, spoiled the sentiment. Sell on news and that demerger structure the market didn't like. HDFC Bank has been struggling to cross 1700. ICICI Bank, despite really good set of numbers, failed to sustain about the 1000 mark. Reliance has fallen about 5% in 2 days. So it's really about these 4 or 5 stocks, and these 4 or 5 stocks practically account for half of Nifty, actually more than half of Nifty, and that's where the problem is. The leadership pocket, just Larsen & Toubro and SBI are 2 stocks where you have sustained rally, but these 2 stocks don't make up for too much of the Nifty. That's the problem. Infosys as well has been struggling. Now the Nifty is at 10-day exponential moving average, and the put call ratio has fallen to 0.91. So I think that's something which is good news, that maybe the market can hold these levels. Fin Nifty is expiry today, so it will have an impact. The last 2 expiries have been poor for the market. The other big cue is Larsen & Toubro's numbers and the buyback. That could be positive. And of course, some big numbers today. Tata Motors, Bajaj Auto, Asian Paints and Jubilant Foodworks. FOMC meet today. I think one half of the market is now getting of a view that maybe it could be an extended pause, and maybe even this time there could be a bit of a pause. As I said, market is at support and put call ratio of 0.81. But if today's rally fails, then that will be distinctly negative. That will change the market's trend, which so far has been buy on dips. But my base case is that at these levels, market takes support.
Okay, all right. Anuj, thanks a lot for that. At these levels, market could take some bit of support. Well, let's get in our technical experts, Mitesh Thakkar as well as Sudarshan Sukhani. Both of them join us on the show. Good morning, gentlemen. Mitesh, well, last couple of sessions, as Anuj was mentioning, that the last hour has been a little bit weakish. How do you approach trade today, though? We're likely to start off in the green.
Yeah. Morning, Nigel. I think yesterday there was some kind of a negative movement happening on the index. I think getting below 19,700 wasn't a very positive thing for me. So what I look for is, if the gap up, which is about 30-40 points, if there's some build up on the gap up, I think it should be okay. But if we fail to sustain about this 19,720 or level after the first hour of opening, then I think we might be in for another round of selling. And we could see some more pullback happening, which would be slightly deeper. And then I would look at targets closer to about levels of 19,500 to about 19,450. So I think the first hour after the gap up opening would be very important. A failure to see build up on the gap up, I think will possibly give you a more selling pressure.
Right. Sudarshan Sukhani is also joining in to give us his view. Sudarshan, looks like this market is in need of another positive trigger to take it ahead. Until then, perhaps it could consolidate. But maybe I'm wrong. You tell me, what's your view and how do you approach it today?
Yeah, good morning, Sonia. Well, any anchor needs 10 years of experience, which you have to actually comment on the market. And you are quite right. This market is looking for leadership and it won't get it. See, let's look at the broader picture. It's been a sustained rally from 16,800 to 20,000, and then with very small stops. Now, are we seriously thinking that the Nifty will keep on rolling 21,000, 22,000, 25,000? It doesn't work this way, and you've seen many markets to know that. Now, I can't say that this is a pause and from here a serious correction will start. It's very proper to say that 20,000 could be a barrier for a long period of time, a long period being defined for a trader's time frame for many days. So I am not buying anything. This is not a buy on dips, environment for me. For me, the trade is ideally you want to step aside and just watch the fun. Now, if a trader has to trade, then trade with very low volumes and trade only on the long side of the market, just intraday. Markets become choppy, and then choppy markets kill and take away all the profits of the long, rally that we have seen. So step aside.
Step aside. That's, I think, wise advice. Gentlemen, good morning. Sudarshan, in terms of specific stock ideas, what would you have?
Well, I have a mix, but it's primarily buying. It is a bull market for whatever it is worth. AB Capital, Aditya Birla Capital is a buying opportunity. The stock had a very messy correction, but that correction seems to be over, and yesterday was a good day. So buy with the stop under 180. Bajaj Auto is in a consolidation after a rally. Now, usually rallies end into a consolidation and the consolidation breaks on the upside. I say usually because if the Nifty starts a correction here, then all of this will fail. But given the charts today, Bajaj Auto is a buying opportunity with a stop under 4,800. My only intraday short is Indiabulls Housing Finance. It's a very messy chart, big wide range bars on the downside. Buy intraday short with a sell above 123. And finally, my positional buy and the best buy for the day is IndusInd Bank. The stock has been outperforming the Bank Nifty, outperforming the Nifty. It had a big wide range bar yesterday after 3 days of small declines. Make this into a positional trade. Buy with a stop under 1390.
All right. And Mitesh, what about you? What would be on your buy and sell list this morning?
I have a mix of buy and sell calls, Sonia. Good morning. A buy on M&M Finance with a stop at 315 for targets of 335, and a buy on EID Parry. It's a cash stock, but the pattern is very good. So buy here with a stop at 470 for targets of 500. On the selling side is SRF with a stop at 2188, sell for targets of 2050. And Godrej Consumer is a conditional sell if it starts trading below yesterday's low of 1030. Sell with a stop at 1045 for a target of 1000 to about 990.
Okay, all right, gentlemen, got those calls down. For the time being, though, we'll slip into a short break. We come back with pre-market opening. We'll also get in Mr. Rakesh Sharma of IDBI Bank to talk about their past quarter's numbers. Don't go anywhere.
Okay, we're getting into the pre-opening rates for the market. Now, this morning, a lot of markets are actually in the green. So the GIFT Nifty is also suggesting a good start. Hong Kong, if you can just pull up the Hong Kong market, 600 points higher. China has put in some support for the property market in Hong Kong. So there are positive statements coming in from China there. And that is really aiding the Hong Kong rebound. China, there's some statements saying that they will adjust and optimize policies in a timely manner for the ailing property sector. And Beijing's top decision-making body has vowed to elevate stable employment to a strategic goal in the Hong Kong market, and that's what's keeping it so buoyant. The Taiwanese index is also in the green. For our own markets too, looks like the start is going to be in the green, but lots of big triggers. IDBI Bank saw a robust expansion in its net interest margin, which was aided by a sharp rise in yields. Their slippages have also declined, but the write-offs are elevated and the deposit growth momentum is weak. Rakesh Sharma, the MD and CEO of the company, joins us now to discuss more on their Q1 performance. Mr. Sharma, appreciate you joining in here on CNBC TV18. It was a sharp rise in yields which aided the very strong net interest margin expansion. Just trying to understand, is this a sustainable NIM situation, and what is the expectation as we move along into the next few quarters?
At the beginning of the year also we had indicated that our net interest margin will be about 3.5%. This quarter there was one-off recovery which was amount around 1096 crore, which was credited to interest account. So that has helped in improving the NII and net interest margin. But even if we exclude for them, that is what we internally monitor, that is core NIM. So the core NIM has increased from 3.73 in June 2022 to 3.94. So there is improvement because we have been able to control the cost on deposit vis-a-vis the yield on advances. That yield on advances has increased. So, and we are quite hopeful that we will be able to sustain this core NIM.
Hi, good morning, Mr. Sharma. Well, could you tell us what's the outlook on asset quality and stressed assets resolution? Basically, what kind of resolutions you expect from the NCLT in FY24? Write-offs as well remain elevated. Why is that?
No, write-off this quarter, in fact, there was not much. It was only 2,000 crore. That too, because of that recovery in that big account which I mentioned. So that account recovery has happened through NCLT only. So this quarter their recoveries were 1,628 crore. That is the cash basically recovery, what we have seen. And the NPS, these have, because of this recovery, NPAs have shown reduction. The net NPA has increased from 0.92 to 0.44. This is also, of course, because of our accelerated provision. The gross NPA has also come down to 5.05. And, one factor also I like to mention here, the slippages have been under control. In fact, it was only 551 crore and 1.16 crore, 1.16% slippage ratio, probably the lowest in the previous 3 to 4 years.
So the deposit growth was weak, but you benefit from lower credit deposit ratio as well. Can you give us an outlook on what the deposit growth look like? What could the loan growth look like going ahead? Would you continue to witness this rundown of deposits in the near future?
Deposits YOY growth is around 8%, 8.74%, and the advances have grown by almost 20%. So both way, but our LCR was quite comfortable. We, in fact, at the beginning of the year, we had indicated that the deposits will grow between around 10%, and advances will grow around 10 to 12%. But this time, because of the retail growth has happened, at around 13%. So this is as per line. Corporate, we have been able to book some good big accounts. So that has helped us in improving the advances growth to 19%. Let us see. Our efforts will continue in improving the numbers in the coming quarters.
Well, any fundraising plans, sir, in the near term? And also any stake sale in any of your holdings?
The fundraising is because you have seen my capital adequacy ratio is 20.33. So we do not have any plan for raising either the tier 1 funds or the equity, because we are comfortably placed as far as capital adequacy is concerned. Now, yes, on the subsidiaries, we have one subsidiary, that mutual fund, because as per the SEBI directions, we had to sell it because LIC is also having one of its subsidiary. So I think by this month end or within a month or so, we will be able to finalize that. But other than that, other subsidiaries will continue, and all subsidiaries are profit-making subsidiaries.
So the operating efficiency improved in this quarter, which is good because the OPEX declined quite a bit, the operating expenses. Are you confident of maintaining this cost-to-income ratio below 40%, or do you see it come back to those 43 to 45% levels?
Generally, as I was mentioning, that one-off income was there that has helped us in showing the cost-to-income ratio around 37%. But if we exclude that, it is around 48% range. So we will be somewhere in that range only, 45 to 48%. And but other than that, operational expenses, of course, in March we had done one-off provision for the salary revision part, AS15 provision. But overall, the cost is under control. Income we will try to improve. The emphasis will continue to maintain the cost-to-income ratio between 46 to 48%.
Okay, well, thanks a lot for that. That's IDBI Bank, but Prakash Diwan is still sitting by with us, so let's get him on board. Prakash, I wanted your thoughts on how an investor should approach ITC now after all the data yesterday. Jefferies came out with a note this morning where they said that some investors would perhaps have preferred 100% direct split, but they didn't get that. So maybe some disappointment there. Your thoughts?
No, I was wondering when this question would come up. So yes, so I think there's been a lot of anticipation around this event, and by virtue of that, it seems like an anticlimax. So probably there is that sense of underlying disappointment here. But ITC is always known to be very tough to let go of control on any of the businesses, and that's why this has taken so long. But my sense is it's going to be positive from the company's perspective. While shareholders would have wanted a 1:1 kind of a demerger and allocation to the new business. But this helps, the company experiment or start with the process of hiving off something which eventually would grow into a bigger piece. The key is looking at FMCG. If that can be done at some point in time, if not immediately, because they'll have to grapple with this transition, I think it's good for the overall distinct shareholders' value creation journey. I wouldn't really get disturbed from that long-term view that I have on ITC being such a promising bet. And as a matter of disclosure, I do have it in my portfolio from a long perspective. But this event will probably get digested very positively after a while, not maybe immediately in today's market.
Prakash, got that. By the way, that sense of disappointment, you're talking about this, the structure in which it is being done, 40% still to be owned by the company.
Yes.
So it's not a clean one. Okay, that's
right.
Got that. Craftsman Auto, reported a strong set of numbers. I think we've discussed this in the past as well. Any thoughts here, Prakash?
So very quickly, Prashant, all of these companies that have got into niche areas and have expanded themselves, including Craftsman Auto, are going to be very promising bets. We have not seen institutional money getting allocated to some of these companies because of lack of scalability, questions around the addressable market being big enough. But, these numbers are telling you that there's much more afoot in terms of a global platform, global stage for most of these companies. I mean, you don't just have a Samvardhana Motherson or a Bharat Forge to reckon with in this segment. There are lots of new contenders that are coming up, whether it's Uniparts, whether it's Craftsman Auto. Some of these companies are doing exceedingly well in terms of scaling up. So I'm quite positive on the space. But, I have my favorites. I have some smaller companies that I'm looking at more keenly, which could grow into, more global players or globally impactful players, if not very scaled up players. So that's the space. But yes, very encouraging. Things look quite positive for this name as well.
Okay. You know what? Let us just get the pre-opening rates sorted and then we'll go across and talk about some more stocks. ITC is the stock that's under a bit of pressure yet again after the move yesterday. So it's down about 0.7%. Tata Motors is in the green ahead of its numbers later in the evening, so up about 1% over there. Cipla comes out with numbers tomorrow. That one's up almost about 0.8%. And in the broader markets, plenty of stocks to talk about, so we'll get straight to that. But first, let's find out what brokerages have made of ITC and the news flow yesterday. Mangalam is here with us. Mangalam, over to you.
Well, at the most optimistic, brokerages are mildly positive on ITC, and at the worst, they are largely unperturbed by this decision. But they've all made important points. And we start with Jefferies. They say that some investors, while they were preferred a 100% vertical split, this move is not likely to have a big implication for ITC's share price because it accounts for just about 3% of their overall share price itself. However, the important points they make, one, that this isn't a precursor going for all the other businesses going the same way. So all those who are pinning hopes on, the next demerger being the other vertical should not, do that. Secondly, they do see a case for ITC to levy a brand loyalty on the hotel business, which means that for the larger entity, there could be some royalty income coming in. There could be some supply pressure in the hotel business post-listing as some of the large shareholders will perhaps look to offload those shares out there. And they also see a case for holdco discount once the hotel business is separately listed. As far as Goldman Sachs is concerned, they believe that their investment thesis on the stock is basis cigarette business profit growth as well as improving profitability in the FMCG business. Morgan Stanley says that this move should allay concerns about capital allocation and hotel business on its own could chart its own growth path. And finally, Nomura says that management control in the hotels business by virtue of this structure is a positive. And secondly, they expect the surplus cash, which would have otherwise gone to the hotel business, will now come to shareholders as a higher dividend profile. All of them have valued the hotel business anywhere between 12 to 24 rupees per share, and their thesis hasn't changed. In fact, all of them have a buy or an overweight rating on the stock with a target price ranging anywhere between 480 to 520 rupees.
Okay, thanks a lot for that. Well, TVS Motor is the other stock that we're looking at. There are both bull and bear case arguments for this. So let's put it on board very quickly. The bull case, of course, is that the commentary from the management was very strong. They've delivered a margin expansion despite the elevated costs. The margins, remember, have come in above 10% for the 7th consecutive quarter, and it is record high margins for the company. And they are the key beneficiaries of the revival that we're going to be seeing in the export market. And industry-leading growth is something that can continue. So here are the bull cases for you. UBS, Jeffrey, Nomura all have buys. They have target prices anywhere between 1,500 to about 1,570. That's the bull case. The stock, in fact, is up about 1.5%. But let's look at the bear case now. There was an increase in staff and freight costs that put little bit pressure on the margins. Also, they are investing in a lot of their subsidiaries, including the loss-making subsidiaries, because of which debt went up a bit. The debt levels have increased by about 250 crores. So the bear case comes in from Citi, CLSA and Goldman Sachs. Citi maintains a sell with a target price of 900. CLSA and Goldman Sachs are anywhere between 1,200 to about 1,340. So both cases exist. I think it's just a little bit of higher debt and investment in loss-making subsidiaries that's putting pressure on the stock.
Absolutely. Well, stocks, I think, in the pre-open up a little bit by about 2% or so. Mitesh is with us with his 9-10 calls. Mitesh, what do you have?
I would suggest taking a short position on Godrej Consumer if it starts trading below yesterday's low of 1,030. Take a stop at 1,045 and a target of 1,000 to about 995 is what.
Okay. And Sudarshan, what about you?
Well, IndusInd Bank is a buying opportunity. Make it a positional trade with a stop under 1390.
Okay. Godrej Consumer and IndusInd Bank. Thanks very much, gentlemen, both of you, for that. Well, Bayer Group has lowered their FY23 guidance. Sonal is here to give us the news and implications. Sonal.
Well, Bayer Group globally, the global major that is, they have lowered their 2023 guidance, and this is, I think, the 7th or the 8th global chemical major that has gone ahead and lowered their guidance. They say this is due to significant decline in sales of glyphosate-based products. So now they expect sales at 48.5 to 49.5 billion euros versus the earlier expectation of 51 to 5,200 euros. The EBITDA as well, they have cut down their guidance to 11.3 billion euros to 11.8 billion euros versus 12.5 that they were expecting earlier. Now, they say that cash flow forecast is also approximately 0 euros versus 3 billion euros that they were expecting earlier. The reasons are price decline, reduced volumes due to channel destocking. Now, the Indian companies that are in the glyphosate product are Bayer Crop Sciences, Sumitomo Chemicals and UPL. So, of course, there's the 8th or the 9th global chemical major that is talking about some pressure that they're seeing on inventory and pricing as well. That is something that will impact the Indian chemical industry as well.
All right. Thanks very much, Sonal, for that. So keep an eye. I mean, actually sticking to that space, right, the chemicals space, I want to put out the chart of Sharda Cropchem. The stock, the stock which started selling off was SRF on the back of the numbers. That also came out later in the second half. But then Sharda also sold off. And the chart is interesting because it seems to be breaking down a little bit here. In the pre-open, it is down, I think, about 2.5%. Let's have the chart up. It'll tell you picture is worth 1,000 words, they say, and I think it's pretty clear what we are sort of indicating towards. So this is, from the lows of 2020, and as you can see, you basically have touch point coming in April of 2023, 11th of April 2023, and I think I don't think we got the extension from yesterday showing on this one, but basically this chart is showing you that Sharda from the rising trend line of March of 2020 is basically, as of yesterday's close, is sitting on that level of 481.35. That is exactly sitting on this rising trend line. So, keep an eye out on this one. A break would suggest further steep losses. And if it is able to kind of, hold on to this, bounce, perhaps it is protected for now. So that is Sharda. I'll put out the chart for SRF as well, which is looking a little wobbly as well, Sonia.
Okay, let's head into the market opening because that is just going to hit our screens now in a bit. There you have it. Good opening for the market, 30 points higher on the index. The mid-caps are up almost about 200 odd points as well. And let's take a look at the first tick on the mid-cap index, up 140 points. The Bank Nifty is the one that's really charging ahead this morning. So 160 points higher on the Bank Nifty. Good opening, decent opening for now. Let's see whether we can build on to those gains. The space that's looking the best this morning is autos. Hero, Tata Motors, Eicher Motors, all in the green right now. Followed by JSW Steel, which is up about 0.6%. And banks are making their presence felt. SBI, Axis Bank, all in the green as we speak. Nestle India and Power Grid are a couple of other stocks that are trending in the green right now. Now, on the downside, ITC, the street was definitely disappointed. There was sell-on rally over there. Sell-on news rather. So down about 1.5% on ITC. Maruti Suzuki is down about 0.7%. Asian Paints down about 0.5%. And SBI Life also trending in the red at the moment. The broader market is where all the action is at because there is a big degree of outperformance that we're seeing in the broader market and plenty of stocks, some earnings impact as well. TVS Motor, by the way, is up about 1.5%. So the street has definitely liked the fact that these are, record high margins. Margins have gone up for 7 straight quarters. So the bull case is emerging stronger at the moment. But otherwise, not a bad opening at all.
Well, that's right. So you said the actions in the broader markets. Boy, it is. SJVN is up closer on 9% as we speak. Big move is what we're seeing on that one. Aarti Drugs is seeing some follow-through. So that's up closer around 4.5%. Volumes as well picking up on that one. So that stock's clearly doing well. On the flip side, you have Sharda Cropchem that's seeing some more selling actually. So that's down. The numbers were very, very poor. It was down 6% yesterday. Numbers came at around 2:30 p.m. odd. It's down another 5% today. SRF as well. The commentary was very weak. So that stock as well is down close to around 2.5%. Chennai Petro, very weak numbers. Stock is down 7.5%. You have MRPL as well that's following suit. That one as well taking a bit of a knock. On the index, the problem I think is ITC that was doing so well for the last few sessions. The news has come spot on. They were indicating that they're making a move on the hotels business. However, the manner is not great, and that's why this market doesn't like it too much. They would have preferred a mirror image, simple mirror image, 1:1, which hasn't happened, but there's a call later today. So let's see whether or not we can get some clarification on that front. But that one's under some pressure, and from that gain of around 40-50 points, we're down to around a 20-point.
Okay, well, 20 points on the Nifty, 19,690 is where we are at. To begin with, I mean, the market breadth seems to be pretty solid. SJVN is up another 9%, so this seems to be in pretty, for now seems to be in pretty strong hands. And it's coming up on volumes as well, so keep an eye on that one. That's the top traded volume stock. Look at that. I mean, I think there are some blocks, etc., which have perhaps gone through because volumes are through the roof as we start the day. There is Mazgaon Dock, so keep an eye out on this one. It's a slow start, but huge volumes, 2% on Mazgaon Dock. There is Utkarsh Small Finance Bank, which is up 3.6%. Stocks at about, 53. We've got Poonawalla FinCorp, reported numbers. Stock did not really react yesterday. It's up 3% this morning, 379 on Poonawalla. Garden Reach is up about 2.5%. Again, in that same, shipbuilding space. So 623 on Garden Reach Shipbuilders. There is Action Construction Equipment, which was up 10% yesterday. So there is follow through with about a 3% pop. Titagarh has been unstoppable, and that one is up another 3% this morning. So there is, a fair bit of activity in the broader space. SRF is down 1.6, so it has bounced a little bit from it's bounced about 30-35 rupees after starting lower. So it's actually a green candle. So let's look at this one and watch this one as well. Chennai Petro, I think we mentioned, down about 8%, 9%. MRPL is down about 4% as well. So standalone refiners are a little lower. But in the broader market, it is clearly more up than down. Yesterday by close, it was 1:1 in terms of NSE market breadth. So that's the overall picture right now.
I just want to make one mention. Tata Motors is at a fresh 52-week high this morning, and that's at 639. So that's a gain of 65% this year already. Of course, comes out with numbers later in the evening and expected to be a good showing from JLR. Not so much for the India business, but JLR, Jaguar Land Rover will be good. So going into its numbers, it's the positioning, is on the long side. So some disappointment
just
if it comes.
Talk about the other Tata Group stock, Tata Steel, that came out of these numbers. The numbers are as flat because the street believes the numbers are not sustainable, and they're asking about how much of the beat in the India business is one-off. We'll know about it in the next 120 to 180 minutes.
Okay.
Right, okay, we'll pick up on this one as well a little later on the show. Well, 20 points on the Nifty is what we have. Andrew Holland is Chief Executive Officer at Devendus Alternate Strategies. He's with us. Andrew, good to have you with us here. Is the market starting to consolidate a little bit? Will we go into a slightly more sideways price action after what has been a very spectacular, fast-paced first half this year?
Yeah, no, it's been a good, enjoyable kind of ride over the last few months, hasn't it? But I think the markets were looking overbought, and it doesn't take, it takes a little bit of one or two kind of not poor results, but results in line, or some negativity around certain sectors, and it just takes the froth away from the market. So I'm okay with markets kind of drifting for a while now, until we get the next catalyst. The next catalyst is really going to be the kind of earnings upgrades, which we're going to start to see from the second half of this fiscal going into 2024. So that's the key for the markets to move higher. So we've had a great run. Everything's worked in our favor. No one likes China. Maybe that will change if there's a big stimulus package in China and take some of those flows away from India in the very short term. But otherwise, nothing to worry me at all, Prashant, at the moment. But I just think we got to a very overbought territory.
Okay. Nothing to worry, but where do you find alpha, right? That's the tricky part, Andrew. What do you do with some of these auto names? We were just talking about Tata Motors at a fresh high. Numbers are expected to be strong. Do you think a lot of the news is already in the price now?
I think, again, certain sectors will have the kind of run up, and I think the autos has had that. I'd probably be more looking at the auto components over the next 2 to 3 months is where you're probably going to get better share price returns, because I think as everyone keeps talking about electric vehicles, whether it's two-wheeler, four-wheeler, it's going to be the auto component companies which will do well. So auto components would be where I would be placing my bets. I mean, don't get me wrong, I wouldn't be out of the auto sector, but you've got to be very selective in which ones you want to back. In each, whether it's two-wheelers or four-wheelers, there's a great competition going on now in terms of the high-end bikes. Who's going to be the winner? We'll see, but that's just going to increase competition and hurt margins in the short term.
Hi, Andrew. Good morning. Andrew, what do you make of the big ITC announcement? The stock has been a big outperformer in the last 18 months to 2 years. Before that, it was a big underperformer, waiting by for some kind of announcement on the hotels business. It's come about, but it's not what market expected. Any view out there?
Yeah, no, I mean, it's been highly anticipated kind of demerger, and I think the market now is thinking, well, we don't really like this for many different reasons. At the end of the day, it's not a bad, it's a good move, and I think you have to look at it longer term as well in terms of how it will help cash flows going forward and ROEs. But in terms of the excitement, I think is probably over. I'm not going to the length of saying you need to have a discount for Holdco and that, because it's too small a business in terms of the overall ITC revenues and profits. But it's at least a step in the right direction. But I think the market got over keen in terms of some of the valuations and some of the thinking that was around this demerger. But as you rightly said before, we'll hear more news today. So maybe there's positive surprises, but I'm not sure I would hold myself for that.
Andrew, a lot of the not ex-bank PSU stocks, non-bank PSU names which have been rallying, right? In the railway space, in the defense space. What do you make of it? It's an election year, the next one. And stocks are already up in most cases, at least 100%, if not more, this year or from last year. Do you own any of them, and do you have a broad view?
On defense stocks?
The non-bank PSU names. It could be defense, could be railways, and many other sectors. I mean, actually, as the rally is broadened, more and more of these names are starting to participate. Yeah, no, so, Michelle, we've always talked to you about the themes that we like, and defense is one of them, renewable energy is another, CapEx cycle, electronics in terms of the whole industry. So these are the themes which will continue to play out in terms of getting better performance than, say, Nifty. And the one that we added recently, a few months back, if you remember, was beverages in terms of non-alcoholic as well as alcoholic, and the premiumization. And I think you saw that with United Spirits results recently, that everyone's moving up the value chain, and that we're only at the start of this runway for the whole of the industry, both for non-alcoholic and alcoholic. So it's going to be a very, very strong earnings story over the next 4 to 5 years, in line with the electronics industry. So those are the two which I would focus in on at the moment.
The tricky part now is that, of course, we're heading into a global situation where it could be the end of the rate hiking cycle, right? We don't know for sure, but perhaps this could be the last rate hike in a while, and that's what the street has been penciling in, both global and local. Do you think that's over-optimism on the part of the equity markets, and how do you approach this global event now?
So, we've always had the view, Sonia, that the Fed were taking the rate hikes have been too severe, and this last one will probably be the step beyond. So we still feel that inflation's coming down. It's going to come down a lot quicker than people are expecting now, and that could still tip the US into recession. I know the Goldilocks scenario is it's a soft landing, and everyone comes out of it with no problems. I'm not of that view. So I still think there's a few hiccups along the way. But as I said before, we're very constructive on our markets. There could be some pullbacks because of global events. But otherwise, this whole prospect of money moving towards emerging markets, which it has done, towards the exporting countries first, and then it'll be India. We're seeing some of those flows already as investors chase growth as we come to the end of the rate high cycle and look forward to interest rates coming down sharply next year.
Andrew, I just want to ask you about the banking names, but for the time being, just requesting my director to pull up the Nifty and pull up the India VIX. Suddenly that's down close to around 10%, 9 to around 10%. Also, normally, cooling off of the VIX is a bit of a bullish sign, but it's cooled off in a big manner. So I'm not sure what's going on there, but just pull up the VIX. It's down 8 to 9%, approximately 9% now as we speak. It's heading towards the lower end of the range. We did see a bit of a bounce in the last few days because of the volatility that picked up. But for the time being, that's something that should be on our radar. We'll keep an eye out on that. Well, Andrew, what's the view on the banking names? Because we're searching for leadership. It appears in the near term, ITC has some bit of issues. Reliance has already, run up quite a bit. So your view on the banking names and the few results that we've already got, what would be in your pecking order?
No, I think the banking results so far has been in line with the market expectations. There's been obviously, I think there's concerns around deposits and NIMs going forward in terms of the kind of challenge in terms of gaining deposits and the price you have to pay for them. So I think that's one of the concerns the market has. Obviously, there's a change in leadership at Kotak at some point, and that will keep the market kind of concerned on how that's going to be, how that's going to go about going forward. So I don't think the pecking order's really changed. I think all eyes are now on HDFC Bank and how they're going to get this merger going, and again how they're going to get the deposit growth given the kind of expectations for loan growth going forward. So all of these factors, I think the market's kind of trying to kind of grapple with. And it's becoming a little bit more of a concern rather than it's a kind of a tailwind at the moment. But I think the banks will get through this very quickly because I think what we're seeing in the economy and the multiplier effects of the government spending and private capex, I think will propel GDP a lot quicker and earnings in the second half of the year, and that again will lead to more lending for the banks. So I remain positive on the private banks. Pecking order is really doesn't change that quickly. But I think the results have shown who's leading at the moment.
Okay, all right, Andrew. Thanks so much for stopping by and filling us with your view on the markets, a lot of sectors as well as stocks that we discussed. Wishing you a good day ahead. Well, we have talked about banks, so let's focus on one bank, Canara Bank. They posted a very good set of numbers in the first quarter. The numbers came better than what the street was working with. Now, their NIMs have come in the highest that we've seen in nearly 31 quarters. Gross NPAs as well, lowest in more than 30 quarters. Corporate loan growth, that's strong, but slippages remain a little bit elevated. To understand what's gone on in the past quarter and what's the way ahead, we're joined by Mr. Satyanarayan Raju, the MD and CEO of the bank. Hi, sir. Good morning. Thanks so much for joining in, and congratulations on a solid showing in the first quarter. My question to you is, what is the loan growth outlook from here on? It seems that it's more focused on the corporate book side because that's outpacing the retail growth side. So the growth from here on, and also on NIMs, it's looking very, very good. CASA has come down, cost of deposits have gone up as well. So how do both those two numbers shape up?
Good morning to you, sir. First, let me focus on the credit growth. The credit growth, we are given the guidance that current year credit growth will be 10.5 minimum. As we given the guidance for the first quarter itself, we could manage that the credit growth is around more than the 13% year on year. Even if you look at the quarter on quarter, it's a more than 3% growth is there in that. The second one, what the composition of the corporate as well as the RAM. Last quarter, we could maintain that the percentage is the 55% is RAM and the 45% is the corporate. Even the current quarter, the growth is in line with the same what we have given the guidance of maintaining the 55% and 45%. Look at that the quarter on quarter growth, RAM itself is more than 3%, sir. The corporate growth is 2.7%. That means that actually our focus on RAM is continuing because to take in higher yields, we want to take that because there is due to the interest expenses, high interest regime, there is a stress on the NIMs margins. To compensate that, our focus on the RAM is continuing. You just the CASA is as a whole, it's a little stagnated or little negative. But the bifurcation what I wish to share with you is there is a growth in the savings bank account from quarter on quarter. That's the reason behind that is that we have taken a lot of initiatives on the first working day of the current quarter itself. We have launched several new products targeting the younger generation, especially the salaried class. Our existing salaried class customer base is 11 lakhs. Because of this product, new product what we launched on the April 3rd, our new onboarding and from the salaried class.
Right, Mr. Raju. Right, sir. Right, sir. You've given us a fair bit of an overview about how the book is shaping up, and we thank you for that. But, your growth, credit growth is outstripping the deposit growth. So what does that mean in terms of NIMs? Because from a stock market perspective, we'll want to understand what kind of a range we should be working with. Please go ahead, sir. Go ahead, sir.
Sir, our CD ratio was only the 73%. We have given in the starting of this financial year, the guidance is we wish to go for the beyond the 75%. In the first quarter, we could show that there is a more than 74% our CD ratio. When you have a scope to go up to 78% and you have enough liquidity at in your system, so naturally our focus will be more on the credit growth compared to that liability growth. The reason behind that is that actually the liabilities we have given in the initial stages itself is 8.5% of the growth in the liability. We are in line with that, and we are sure that we maintain that, because ultimately we have to manage effectively the margins on that, and that has given the comfort to us to that under this present high interest rate regime also we could able to maintain our NIM at 3.05.
Okay. So I wanted to talk a little bit about the asset quality as well. The slippages amount has gone up substantially this time, almost 3,500 crores. This compares to less than 3,000 crores last quarter. What was the reason for that? And if you can just tell us what is the guidance? I'm just trying to understand, going forward for FY24, what is the guidance on both gross NPAs and slippages? I don't think we can hear him very well.
I think he couldn't hear you, Sonia. I think he was answering the previous question. We'll just have Mr. Raju back with us from Canada in just a bit as soon as we are told. I mean, just to take a quick look at the market in the meanwhile, we're up 28 or 30 points or so, and market breadth is about 3:1 in favor of advances. I think he's back with us. Sonia.
Okay. Mr. Raju, is my voice reaching you?
Yes, madam.
Okay. I wanted to ask you about slippages, because the slippages have gone up quite a bit this time compared to last quarter. What's the outlook on that? Is the asset quality expected to worsen before it gets better?
No, madam. Actually, we have to compare the slippages always based on the circumstances of the first quarter of the previous year and the current first quarter of the current year. We should not compare that the quarter on quarter March, because the first quarter generally in the industry, because of that 1/3 staff will be transferred and by settlement and all those things, it's one or 2 months it will be settled down there. The another one is in the first quarter, the agriculture will pay a higher, show a little slippages because of renewals. The sowing season will start only in the June. These two things, otherwise I don't see any concern on the slippages. It's a marginally high in the first quarter compared to that the last March quarter. But when you compare to the first quarter of the last year, the 3,949 to it has come down to 3,428. Whatever the guidance we have given that our slippage will be around 1.3, we are confident that we can manage that 1.3 below than that current financial year.
Okay, so 1.3% slippages for the full year, FY24. What about your estimation of credit costs for the year, sir? Where would that be?
Given actually the credit cost guidance is 1.20, sir. Already we achieved at 1.10. We are expecting that the guidance is a minimum 1.2. We are expecting that around 1.1%. That's not what we are expecting, because we are focused on strengthening our PCR, sir. Compared to that the other things, we have given a guidance that we want to improve the PCR to beyond the 90%. So for that, we have to provide additionally to make my balance sheet a future stronger.
Okay. Mr. Raju, just to pick on the earlier point that we were discussing, this new schemes to attract more deposits that you said you've launched immediately at the sort of beginning of the first quarter. Could you tell us, I mean, what is your expectation? How much could this lead to by way of deposit gathering? And also, do you expect a big scramble for deposits? I mean, is it getting harder? Could you give us an overall picture?
Yes, sir. The first, let me speak on the products what we have launched is, one is the premium payroll, one is SB Select, one is current account. These initiatives, and we also has provided API banking launching to the corporates to deal with us, to divert their ancillary business to us. This has given in the first quarter, first 4 months, we got a 3,300 crores in the CASA itself, the accumulated CASA. We are expecting that our entire machinery is focused on that. And from July 1st onwards, we introduced a relationship manager concept to addressing the savings bank customers in the 5,000 branches. I'm sure that with these initiatives, our CASA will be taken a main focus in our approach, and that will take care of our requirement. Regarding the interest expenses and all, this quarter also we see that the same tempo is continuing. We have not seen any softening of interest in the current quarter. We expect that this softening may start in the next quarter onwards once the liquidity in the system is improved.
Mr. Raju, let's talk about some fundraising plans. Do you have any fundraising plans? And what's the plan with the other listed entity? That's Canfin Homes. Are you looking for a buyer, or has that been shelved for now?
Sir, actually the capital, we are already maintaining a more than 16% compared to the peer banks. We are very strong on that. Again, our board has permitted us to go to the market to raise 7,500 Tier 1 and Tier 2 bonds. 81 bonds is 3,500 crores and Tier 2 bonds is 4,000 crores. And we already got the permission from the board. We will come to the market whenever we feel that the pricing is competitive for us. That is for capital rising. The second one is the Canfin Homes. The Canfin Homes is the Canfin Homes. You see that the whatever we have given you, that's we are continuing with that. First, we want to focus on the strengthening of that Canfin Homes. We want to see that the value of the company is doubled in 3 years. That is our main focus immediately. So at this juncture, we are not looking at selling our stake. We want to continue with that Canfin Homes till we satisfy that the value, real value as reflected in the market. So our working is focusing on the doubling the value of that company.
Okay, so you're looking to double the value of Canfin Homes. You're not looking to pare down any stake in Canfin Homes, at least in FY24. Got that? Any other subsidiaries or JVs where you're planning to bring down your stake?
Yes, madam. Actually, our another two major important subsidiaries are Canara HSBC Life Insurance Company and Canara Robeco Asset Management Company. These two are also our key subsidiaries. In that, we are holding a 51% stake in both the companies. We already has given an advice along with the other stakeholders. We have taken them into confidence and given a guidance to these two boards to initiate the process of going for the IPO. And they already, both the companies have started their work, but it needs around the 18 months time. We expect that these two companies may come to the initial public offer in the second half of the next financial year.
Okay, all right. That's important information. Thanks a lot for joining in. We've run out of time, not out of questions, but thanks a lot for speaking to CNBC-TV18. Well, that's the word coming in from Canara Bank. The market is very, very quiet. The mid-cap index is doing quite well, though. So on the other side of the break, Amit Dixit of ICICI Securities will join in to review the Q1 performance of Tata Steel and other earnings from the metal space. Later, we'll connect with the management of Thangamil Jewellery to talk about their Q1 earnings as well. Stay tuned.
Welcome back. Well, the markets are just holding on into the green. The good news, though, is that the broader markets, you have way more number of stocks that are advancing in comparison to the number of stocks that are declining. Though the declining stocks from around 300 to 400, it's moved up to around 700 stocks that are declining. The crisscross lines will tell you the picture. They're coming a little bit closer to each other. But the big number that we got was Tata Steel. And the numbers look better than what the street was working with. while JSW Steel as well reported a solid set of numbers. Amit Dixit, the analyst at ICICI Securities, joins us to decode those numbers. Hi, Amit. Well, in a short while from now, we have a media interaction and you'll have a con call as well. But what did you make of Tata Steel's numbers and what are the key points you're looking at for the management to clarify?
Yeah, hi, good morning, Nigel. So, Tata Steel numbers, as you rightly said, they are ahead of street estimates. In fact, Tata Steel Europe was in line. And if I can say about domestic business, the realizations were higher than most of the people would have penciled in, including us. I would say the greatest highlight of this result was the insurance buy-in of the pension liabilities at the UK operations. I think that is something what would give great comfort to the market in terms of the future strategy or the future steps that the company might take with respect to UK business. Otherwise, if you look at the other finer prints like, net debt that has gone up slightly, mainly because of the capex, both JSW Steel and Tata Steel have been incurring capex at their respective brownfield expansions. And therefore, it was not entirely surprising. Plus, do remember that first quarter is usually the time when working capital buildup happens. So nothing out of turn over there. So I believe that the results would have satisfied everyone on the street. I mean, there is nothing to be dissatisfied about.
All right, Amit, you're saying that pension liability is solved now for the UK business, which is good news. What can they do but now? So should they be, selling the business? I don't know whether anyone takes it in the current form. If they shut it down, will you see that as a positive? Because now the pension liability is out of the way. The way ahead for the UK, though, is going to be very important because that continues to be a drag. So what would you like to hear on that front?
Yeah, so if you look at the recent times, the management has been taking steps to streamline, to de-risk the UK business to a very large extent. And this pension liabilities was a big element to it. Now it has been removed. And as we understand from the last con call, the useful life of UK assets is 1.5 years. And management is engaging with the government in UK to ensure that, there is a level playing field, or there is the operations actually get more sustainable. Now, any of these options would be taken very positive by the market. Plus, de-risking actually what it does is that in case, in the event you want to take any affirmative steps, it will be far easier for the company to take it. Although they have not announced it anywhere in the public domain, but it would be great if they can somehow, get either curtail the operation significantly or somehow get their skin out of the game from there.
Okay. I wanted your thoughts also, Amit, on JSW Steel. The numbers looked very strong, but do you think that the valuations are a bit expensive at the moment? And what do investors do here?
No, so exactly that was our tagline of the report also, that numbers were quite robust. And these numbers were robust. If you look at the fine print between Tata Steel and JSW, very, very similar thing, that because of domestic realizations being higher, not domestic actually, the blended realizations being higher, partially because of export component, partially because of contractual prices, there was a beat. However, in case of JSW, although the company is on its growth path and it is one of the very, very few companies in the world that actually can boast of adding steel capacity every year. However, with growth comes the leverage. And while the company is not incurring any incremental leverage, I don't think that the debt will go down as well. And that actually makes it more prone to the steel prices cyclicity. And this is something that we would be wary about. So that's why the valuations are rich, and therefore we have a hold rating on the stock at the moment.
Okay, all right, Amit, Tata Steel has been talking about reducing debt by $1 billion approximately. For this year, what are you factoring in your numbers? How much of debt can they reduce? It's gone up by 3,500 crores in quarter1 because of the capex. But are you factoring in a $1 billion reduction or less or more?
See, Nigel, that $1 billion reduction is not something cast in stone. The management's, I would say, the thought process is to reduce debt by $1 billion. In few years, where in some years where there would be heavy capex, this can be lower. While in the years where the capex is not there, it can be higher. Overall, if you look at the, let us say, 5-year scenario, the average debt reduction per year would be $1 billion. But having said that, in our numbers, we have factored factored in a little bit lower than 1 billion. In fact, we have factored in around 5,000 crores of debt reduction in FY24. Okay. But in FY25, we have factored in a little bit higher. The reason being that we expect that most of the capex of Kalinganagar phase 2 would have already been done, and therefore there would be cash flows from there. And therefore, if you look at the overall picture, both FY24, FY25 combined, then the debt reduction is 2 billion. That still comes to 1 billion per annum.
Okay. I just have a slightly macro-ish kind of question because it's metals and commodities. Yesterday we had the Chinese Politburo, the second of the three which are held in a year. And generally the commentary out of there seems to be that there is no, it's an acknowledgement that growth is slowing sharply in that country. But there is nothing in terms of big stimulus or anything, no indication of it. Is that necessary, Amit, for a tailwind for the sector, or you think it doesn't matter?
No, it does matter. In fact, anything to do with stimulus is a positive thing. But what we have seen often, of late, that the Chinese stimulus has had diminishing utility. So they have been trying to stimulate the economy, but it has not happened so far. In fact, we, in our numbers or in our outlook, we have not even factored in stimulus. If it comes, it's a positive thing. What we have factored in, though, is the production curtailment. So the flat control policy, for instance, in China, the fact that there are certain blast furnace operations in Tangshan that have been asked to curtail their operations. I think these are positive. So if production is lower, export is lower. And, from China, only two things matter: what comes out of China and at what price. So price-wise, we are comfortable now. We have seen prices coming up. So from $525 per ton 1 month back, prices are now back to 570 range. If exports also reduce, so that would be a tailwind. We are not factoring in, to be honest, any stimulus measures.
Okay, just one final question then. The problem with Vedanta, as we all know, is the debt situation, right? And that has sort of made investors averse for a long time. Do you think that will be an overhang for the stock even in this year, or can things change?
It's a difficult question, to be honest. This has always been an overhang, high debt, and the fact that, zinc prices have not been doing well, and zinc still accounts for close to, 50 to 55% of overall earnings. So clearly that has got a headwind on the earnings, and therefore the debt situation would remain precarious. And however, to offset it, there is always a dividend, a phenomenal dividend yield for investors. But I think overall, what people are looking at is the maturities at Vedanta Resources. So as and when they happen, as and when the dates come closer, there would be a little bit of ripples in the market as far as the stock is concerned. But overall, I think they should sail through because the business fundamentals are okay. However, there could be intermittent, I would say, wavering in earnings, particularly LME zinc prices not doing great is something that remains a concern at this point in time.
Are you covering the stock as of now, Amit, or it's not under your co-coverage?
Well, it's we are covering it, but it's under restricted list, so I can't really speak about the outlook and the estimates that we have.
Got it. Thanks very much, Amit. Appreciate your time here on CNBC-TV18. That's a conversation around Tata Steel and other steel companies, primarily, of course, a little bit Vedanta as well. Well, we move on to our next company, Thangamile Jewelry, which is a Tamil Nadu-based jewelry company, reported a blockbuster set of earnings. Their numbers came through during market hours yesterday. The stock shot up. I think it was up almost up 20% at one point, cooled off a little bit. Now, gold jewelry sales for the company are up 27% in the first quarter. 2 days of Akshaya Tritiya sales accounted for 109 odd crores, and that is a 37% surge. The stock's done very well, 100% in the last 3 months or so. Mr. S.M. Lakshmanan is Vice President, Finance and Accounts at the company, and he's joining us now to take some questions. Sir, good morning. Good to have you with us here. Prashant this side. What has changed, sir, in the company? Because last 2 quarters, you've kind of moved into a different margin zone. 8 to 10% as compared to the 4% that you used to clock for many quarters prior to that. Could you start there? Has there been any change in the accounting policy? Go on, sir.
Good morning. Thank you for the opportunity. As you said, financial year 23-24 has started on a strong note. Q1 financial year 23-24 sales is 959 crore rupees. All the products volume growth has been shown in the first quarter, year on year, as well as sequentially. Yes, as far as the margin aspect is concerned, non-gold composition, non-gold product composition, the company focuses on very vigorously. Diamond has been doing wonders in the company, and being the high margin product. And in every quarter, the company has been having a diamond day, which tries to amass the diamond sales, and this is being done for the third or fourth quarter. And every quarter, the diamond date has been trying to show good improvements. And yes, the company, the non-gold composition for this Q1 is at 9.5%, as compared to the past numbers of 8.5 or 8 or 9.5, and the company is on its path towards a 10% non-gold composition in the short term, and eventually in the midterm, we are looking at 12% non-gold composition. This is one of the primary changes that have been taking place in the company in the recent past, and definitely youth appeal goes along.
Sure. Mr. Lakshmanan, so you're saying that so you're saying that the non-gold component is going to go higher. You're looking at about 12% in the medium term. Got that. If you can tell us, what does medium term mean? I mean, are you looking at getting it to 12% by, say, FY25 or in FY24 itself? And if this is the case, then does that mean these 10% margins that you clocked in this quarter is something that you can better? Can you sustain it?
Yes, this 10% non-gold composition I'm talking about, let's take FY24, March 31st, 2024, and 12% probably by FY25 or FY26. And yes, there is every possibility that the company will be able to sustain the margin because of these reasons. And even in the gold, which tries to have 90% of the sales, yes, the high margin product mix has been taking place in the gold as well.
Got that. So, just to understand, is there a kind of earning sensitivity thumb rule that we can apply to you in terms of if gold, because gold will still be, even in 25, will be the predominant sort of chunk of the business. If gold prices move up, this is how much earnings will move up by, or if gold prices fall this much, how much, this is how much, this is what the impact on P&L is. Is there a thumb rule, earning sensitivity?
No, we have very clearly mentioned in the results that operating profit has been doing very good, apart from the pricing or inventory profit, which has been shown very clearly in the results to the extent of 32 crore rupees for the first quarter. Talking about the operating profit itself, yes, the company's efficiency levels have been improving in a focused manner quarter after quarter, year after year. For example, let's take the expenses here. So the company is having the expenses in a consciously controlled manner, be it the salary cost, or be it the media cost, or be it the rent or other administrative expenses, promotional expenses. The company has been incurring only to the effectively, relevantly required extent.
Okay. So can you tell us what the game plan is for the business as far as expansion goes, right? So far, you've been a Tamil Nadu player. Are you planning to diversify or move beyond Tamil Nadu? And what would the store openings look like? What is the targeted store openings in FY24?
Yeah, we started the financial year 23-24 with 53 showrooms. One showroom had been opened in Q1, which is Kumbakonam Delta Belt. With the impressive performance having been seen in the Trichy showroom, we are going ahead with the Delta region, and the first one is Kumbakonam. Okay, as far as the remaining months or quarters of the year are concerned, let me talk about in 5 sub-elements. First one is that the company is looking at 4 to 5 new showrooms to be opened in Tamil Nadu, in the state of Tamil Nadu.
How many?
Okay, we are looking at the forming of the location, etc. Probably.
Sorry, Mr. Lakshmanan, how many, sir? You said how many?
4 to 5.
4 to 5. Okay.
4 to 5 new showrooms. Okay. The second point is the company is setting its foot in Chennai in the first quarter of FY 24-25, which I mentioned in the last session as well with the CNBC, for which the preparatory work have been going on during this financial year. The third one is that the company is on its relaunch path as well. As far as the current year is concerned, nearly 6 branches are getting relaunched. Fourth point is that the company has got small format showrooms called TMJL Plus, primarily for silver articles, silver goods, as well as the customer advance collection sectors. 4 of these showrooms are getting upgraded during this financial year. The fifth sub-element of expansion is the company is going ahead with the boutique shops, one for silver and one for the diamond in the Madurai town during this financial year. So the company is calculatively aggressive as far as the expansion is concerned, and setting its foot in Chennai in the first quarter of FY 24-25, going to be accompanied by 3 or 4 more suburban showrooms in and around Chennai.
Okay, all right. We'll let you go on that note. Thanks a lot for joining in. The stock is on a tear, up 6.5% right now. So the street definitely likes what you're saying. Let's get back to the markets then and focus on the big movers here. The headline index is very, very quiet, but it's the mid-cap end which is looking pretty good. So Mitesh Thakkar is joining in to give us more on that. Mitesh, at 10 a.m., what are the trades?
So the market has been very flat and very subdued post the opening, but on the stock side, I think the railway stocks could again pick up momentum after a cool off yesterday. So I'll suggest a buy on IRFC. Keep the stub below levels of 33.90 and a target of around 36.5 can be looked at on the upside. While on Britannia, I have a negative call. So that's a sell. Keep a stop at about 49.85, 49.85 and a target of around 48.50 can be.
Okay, well, we'll leave it there, Mitesh. Thanks very much for that. We'll take a quick commercial break here with news that the indices are absolutely flat on the so quiet. Look at Sharda Cropchem. Just want to leave you with that one. It's down 6% after yesterday's 6% cut. So that is sharply down. And the other one is SRF. We were talking about that in the morning as well. That is recovered. I mean, it's still down 1.33%, but it's a sharp recovery on SRF. The low was 2,040. And that is recovered about 75 rupees from the day's low, which was pretty much, I think, right at the open. Manisha will be joining us with a commodity check and more stocks which are moving around after that. Stay with us.
Hungry. Welcome back. Let's get a quick handle on what's happening in the world of commodities. Manisha Gupta is joining in. Manisha, what's the one commodity you're tracking today?
Well, I'm looking at energy as a sector because, the inflation concerns are really back. It's not just the food as a sector which seems to be surging in sense of prices, but the energy prices have been on the higher side as well. Starting with the crude oil prices, and we are trading at around 3-week highs onto this one. The prices did gain 2% overnight, and we have seen 4 weeks of gains already into the market. $83 a barrel of a high is what we saw in the New York session yesterday, and we're trading around those levels even at this point in time. Two major factors. One is the tight global supply, and the second is the firm Chinese demand is what is keeping the prices at a 3-month highs. Starting with the global supply first, and remember, Russia and OPEC and allies have deepened their output cuts for the month of July, and they're following it furthermore for the month of August as well. And the markets do believe that in this quarter and the next as well, you could be looking at tightness coming in. And if the demand comes in from China, that could further support prices. There is geopolitical premium also building up as fighting in Russia and Ukraine escalates, and that premium is into the prices also. China, in the meanwhile, is looking to increase further in liquidity injections into the private projects there. Citi, that has led to Citi coming out with a report suggesting that for this quarter, the third quarter of calendar year, $83 a barrel is what they're estimating as an average price for the Brent markets there. And then it is also going to be about the U.S. inventories, which may show a decline. That data comes in today and tomorrow. And what also comes in today and tomorrow is the U.S. Fed meeting. The 2-day meeting kickstarts today, and we will hear the guidance and the outcome tomorrow evening. While the 25 basis point of a rate hike has been factored in, it's really going to be about the guidance going forward that the street will be watching out for. And then you have the European Central Bank meeting that comes in on Thursday. So the next 3 days is going to be quite eventful. Not just crude. If you look at the natural gas prices, we have seen them trading at near 1-year highs. There's increase in demand. There is decline in inventories, and those are supportive factors there. Take a look at what the prices have done on a weekly and a monthly basis then. And this is a sector that seems to be really surging for the month of July here. So for the week, we are up anywhere between 2 to 8%. As you can see, whether it's Brent, gasoline, heating oil. Urals oil is Russian oil, which has seen 6% of gain on a week basis and 17% up for the month of July as well. And that's exactly what the month of July has brought in for you. 6 to 20% of gains is what we've seen coming in for the energy markets for this month.
All right, Manisha, thanks very much for that. So that's basically the commodities picture. Let's move on and talk about a few specific stocks which are moving around. SJVN, big volumes and big gains as well. The run has been non-stop. Vivek is here. He's going to focus on SJVN for us. Vivek.
Well, good morning. We highlighted this, earlier today as well. So the slew of order wins that the company is getting as far as its renewable energy is concerned is something is actually aiding the rally as far as the stock is concerned. So today, the company has declared that the Andhra Pradesh government has allotted 5 projects worth over, 5 gigawatts for the company. And all of these projects are located in the Dibang Basin as far as Arunachal Pradesh is concerned. The company says that this particular projects will entail an investment of over 50,000 crore. Now, this is in continuation to the other order that the company received on July 22nd, where the company received a letter of intent from the Punjab Power Corporation for 1,200 megawatt solar power projects, and these projects would be developed again on a build, own and operate basis. Project cost for that is over 7,000 crore. Now, the company has a stated target that it has given as far as the analyst community is concerned of 5,000 megawatts by 2023-2024 at the end of 24, that is, and 25,000 megawatts by 2030, out of which over 50% of the target has to come from renewable sources. So the slew of order wins is actually aiding the company meet its stated 2030 renewable energy targets, and that is what is aiding the rally as far as SJVN is concerned.
Okay, and remember, we had highlighted this stock in top 10, and Vivek had highlighted that it could be in the green. It is the big mover this morning, up 6.5%. But Chennai Petroleum, DCM Shriram, Sharda Cropchem was all on Sonal's radar. And she had spoken about how these stocks could be under pressure in top 10. And look where it's at, down almost 8-10%. Over to you, Sonal.
Thank you so much for that. Well, 2 of them reacting to earnings and 1 on weak commentary. Let me start with Chennai Petro. Lower cracks is what impacted the earnings this time. Revenue down 18%, margins lower by 300 basis points, and profit declined around 45%. And GRMs were also lower on a quarter-on-quarter basis. The stock is lower in trade, and so is MRPL on the back of weak numbers from Chennai Petro. DCM Shriram, another weak set where revenues declined 2%, EBITDA was down 60%, profits were down 78%, and it's their chemicals business which did not do well. That's where the EBIT was was down 90%. Vinal segment saw a loss of 3 crores versus an EBITDA of 70 crores. Now, Sharda Cropchem reported numbers yesterday, but their commentary did not look so good. They reported a loss this time versus a profit. They said revenues degrew due to lower sales in Europe and NAFTA region. They saw lower pricing, especially in the US markets, and there is high inflation, recession and adverse weather conditions as well. Raw material and finished goods sales price have reduced substantially. However, the company is seeing an improving trend in Q2, but across chemical names, we are seeing some weakness in Q1.
All right, Sonal, thanks very much for that. We're up 12 or 13 points, so it's neither here nor there. The indices are trading kind of flat. Now, Surabhi is focusing on JK Paper. She told us in top 10 that the stock will be higher today. It is. Surabhi, take it away.
Thanks so much for that. So JK Paper reported a good set of numbers. The revenues were up 11%. There was some pressure on the gross margin front due to higher pulp costs, but they've still managed to maintain their EBITDA margins at 30%. The EBITDA was up 13%, and that was aided by lower power and fuel costs. The PAT was down 18% on a year-on-year basis, and that was because the finance costs were higher. The management said that the results have improved due to the acquisition of the corrugation business that they had made last year, and also Shirpur paper mills have increased volumes and better realizations, which has also aided the revenue growth this quarter.
Okay, thanks a lot for that. So lots of stocks. Cement stocks, by the way, are surging right now, so don't lose sight of that. ACC is the big gainer, but let's take a quick break. On the other side of the break, our special segment, it's the economy. Lata will get chatting with Manish Agarwal of Phillip Capital to talk about Q1 earnings in the banking space. Stay tuned.